All right. Good morning, everybody, and welcome to Boyer & Ritter's January 2025 plan update. It certainly feels like January at -2 degrees this morning, but we'd like to welcome you to this webinar. So during the program, just a few housekeeping items. So all attendees' lines are muted. The question board is available and it is monitored, so please look for that Q&A icon on the webcast toolbar. The chat feature has been disabled. There'll be a slides and a recording of the webinar available after the webinar. And at the end of the webinar, there will be a Q&A period. And any questions that we don't get to during the Q&A period will be accumulated and provided along with a copy of the slides. So just another note on earning CPE or SHRM credits. There will be 4 polling questions. Any answer counts. Doesn't have to be the right answer. It can be any answer. You do need to respond to 75% of those polling questions to receive credit. If you want to receive credit, email mhall@cpabr.com and specify CPE or SHRM credits. Those certificates will then be emailed to you. So just a brief look at our presenters today. You've got myself, Kim Williams, Kailee Hirschbock, and Jaime Onk, and we are members of your Employee Benefit Plan Services team. We're going to go ahead and look at 3 different areas today. So we're going to start off with a 2025 Employee Benefit Plan update, and we're going to move into preparing for your 401k audit, and we're going to end with common audit findings and ways you can prevent them. So let's jump right into the 2025 Employee Benefit Plan update. Again, my name is Kim Williams. I'm a principal with Boyer & Ritter, chair of the Employee Benefit Plan Services Group, and I've been working with plans for over 25 years. We provide audit, tax, and consulting work related to various types of benefit plans. Today, I'm going to cover a few different topics related to 2025 updates. We're going to take a look at a review of the 2025 annual benefit limits, 2025 mandatory and optional provisions under Secure 2.0, and a few future mandatory and optional changes to consider. Taking a look at that annual benefits limit, we're going to take a look mostly at defined contribution plans. So you'll see an increase in elective deferrals from 23.5, and last year it was at 23,000. Catch-up deferrals are 7,500 for over 50, but what you will see is an extra provision in there for those individuals aged 60 to 63. That amount goes up to 11,250, and we're going to dive into that a little bit deeper later in the program. Looking at your highly compensated employees, those employees are individuals at 160,000. Annual comp limit for benefit purposes is now at 350 for 2025. Annual comp limits for your key employees is at 230,000. And then the maximum amount that you can have as an annual contribution, and this includes employee deferrals and employer contributions in a defined contribution plan, is 70,800. And you'll see that individual retirement accounts remain largely unchanged. So we're going to dive right into a couple provisions of Secure 2.0 that are applicable here in 2025. And I want to just add a caveat. This is the regulations as they stand right now. They are subject to change or it could be revised. There's a few proposed regulations out there. So just to put that out there and let you know that this is where we are today. So we're going to talk about automatic enrollment for new plans, eligibility for long-term part-time employees, that increase in catch-up contributions that we talked about on the last slide. And then we're going to look at this retirement savings lost and found database that was created. Automatic enrollment. So you'll see it's mandatory, but there are a few carve-outs here. So it's mandatory for new 401k, 403b plans that were adopted after December 29th, 2022. And so as of January 1st of this year, you need to automatically enroll eligible employees if you qualify for this. And so that initial rate has to be between 3 and 10%. There will be an auto escalation feature of 1% annually. The minimum it can go to is 10, and the maximum it can go to is 15 under auto escalation. And as always, employees can opt out of the automatic enrollment or automatic escalation feature at any time. And of course, with any feature that's mandatory, there are always exceptions when we look at these. So plans established before 12/29/2022, so your existing plans, they do not have to have automatic enrollment. It's not mandatory for them. Any organization in existence or in operation for less than 3 years also does not have to have automatic enrollment. If your company has less than 10 employees, you do not have to implement this. And church and governmental plans also do not have to implement this. And that brings us to our first polling question.
Okay, polling question number 1. What is a valid exception for automatic enrollment? A, the organization has 25 employees. B, the organization has been operating for 5 years. Or C, the organization is a governmental plan. We'll give everyone a moment to get their answers in.
All right, thank you, Jamie. And so, because I know everyone loves to know the answer to that question is C. It's a valid exception if you are a governmental plan. So let's move into the eligibility for long-term part-time employees. So when this first came out, that was with the original Secure Act. I was wondering, how on earth are they going to count all these people? 500 hours, that's a lot of part-time people. But they did give plans several years to comply with this. And the criteria for that is that they need to have 500 hours of service per year for at least 3 consecutive years. So these are not people that quit and come back and quit and come back. These are people working for you just on a part-time basis. They need to be over 21 by the end of that 3-year period. And then the employee would also earn vesting credits for all the years with at least 500 hours of service. And so that was the Secure Act. Now, Secure 2.0 comes in and says, well, 3 years seems long. We're going to go ahead and we're going to reduce that to 2 years for plans beginning after December 31st, 2024. Something to keep in mind there. It also extended it to 403B plans. And then the rule doesn't apply to union plans or defined benefit plans. So when I get asked a few questions about this, some of the commonly asked questions you can see below. So does this provision impact top-heavy and non-discrimination testing? And that really does matter because, that's the difference between more refunds for your employees. And the answer is no. The point of the long-term employees was to allow them to defer. And so they are excluded from this plan testing. Another question I get asked often is, are plan sponsors required to make employer contributions to these long-term part-time employees? And the answer to this is no. So this provision was really designed to allow these folks to defer, but there are no changes to your employer contributions. Those requirements remain unchanged. As an employer, you can choose to contribute to them, or you can keep it as it was. Oh, we talked about this on a couple slides, this increased catch-up contribution. So catch-up contributions are optional, and they came about way back in 2001 under EGTRA, which is the Economic Growth and Tax Relief Act. And it was really designed because even then they knew people weren't saving enough. And they said, what can we do to help older people save a little bit more? So they allowed a special catch-up contribution for those over 50 to add additional amounts to their 401k plans. And really, it's remained unchanged until Secure 2.0 came in. And Secure 2.0 said, okay, well, we're going to add a little bit more for those employees aged 60 to 63. After December 31st, 2024, they can begin additional contributions. So that really will start this year here in 2025. And so they are allowed to contribute up to $11,250. For all other employees outside that age range, you are still at $7,500. And then for simple IRA plans, it's a little bit more of a complicated formula, but ultimately you will end up between $3,850 or $5,250, depending on where that calculation comes up. Another interesting result of Secure 2.0 was that it required the EBSA, the Employee Benefits Security Administration, to provide some sort of search tool or database for participants to look for lost retirement accounts. And it took about 3 years to do that. And it allows individuals just to go look up under their name, do they have any assets hanging out there? Now, what I will say about this is it's voluntary participation by plan administrators, so it's not mandatory. So every company is not going to have their information out there. It's on a voluntary basis. But if you do want to sign up for it or your employees ask, how do I do this? You do have to create an account through login.gov. If you have an existing account, you can use that as well. And you'll need your driver's license, social security number, things that you would expect, your phone number match in order to set this all up. Now, I did do this just for fun because I wanted to see if it worked. I was able to get in there. I did have to actually scan my face. So that was fun to make sure it was really me. And they sent a verification. And I went through all that, but I didn't have anything hanging out there. I knew I wouldn't. However, it does work. I mean, it's possible to get in there and do a search. But this database is really participant specific. So it's the individual looking for anything missing accounts or missing money. So what can we do for the employers? Because when we look at employers, a huge question I get asked, probably 3 or 4 times a year, is I have these people, I can't find them. What can I do? Well, hot off the presses, on January 14th, Field Assistance Bulletin 2025-1 came out to provide a little bit of relief for that. And what it allows you to do is, if the missing participants balance is under 1,000, so we're talking small dollar values, you can transfer that money to a state unclaimed property fund as long as certain conditions are met. So you do have to qualify to make sure that you can do that. So you have to make sure that that state fund is a good destination for those funds. You need to make sure that you have at least attempted to implement a program to find these missing participants. That can be really difficult. If people move, it's been 20 years, you don't know if they're alive or dead. It can be a very difficult thing to find people, but you need to implement a program to do that. And then when that fails, you've looked, you've tried, you are able to, as long as the funds are under 1,000, go ahead and put those funds into a state unclaimed property fund. Now, there is one rule to that. So what you do have to do is make sure that the state you put that into is the last known address of the participant that you've lost or is missing. So if you're a Maryland company and your employee previously worked or lived in Pennsylvania, that was the last known address you had for them, you have to turn it over to the state of Pennsylvania. You also need to make sure that you add to your summary plan description just an explanation that missing participants or beneficiaries may be transferred to an eligible state fund. So that needs to be in there. And then the state unclaimed property fund, you need to make sure that it qualifies as an eligible state fund. There's more information in that specific bulletin if you want to take a look at that. And with that, that brings us to polling question number 2.
Okay, so polling question number 2 is just throwing some numbers out at you to see who's really paying attention. The question here is, what is the maximum catch-up contribution for a participant who is 64 years old in 2024? So your options are $7,500, B, $10,000, or C, $11,250. Just a reminder here that you don't need to have the correct answer, but just make sure that you answer them for credit. I'm going to give it back over to Kim.
Okay, and so it's a little bit of a trick question, but the correct answer for this one is 7,500. 10,000 isn't anything. And the 11,250, again, that's for those participants between those magic ages of 60 and 63. So if you're 64, sorry, you're still only getting 7,500. So a couple provisions on the horizon that we're going to take a look at. We're going to take a look at qualified long-term care distributions and then Roth only catch-up for high earners. The qualified long-term care distributions relate to distributions of a maximum of $2,500 per year to pay for qualified long-term care insurance without triggering that 10% penalty. Now, you still will have to pay tax on that because it's an early withdrawal. You just won't have to pay an additional 10%. And this optional change is effective. This will go into effect in 2026. But you can get it. It's December 29th. I don't know why they like to do this, but if you take one out on the 30th, it would count for this. But for the most part, it will probably be in effect in 2026. And again, this is optional. So the Roth only catch up for high earners. This one also will be going into place in 2026, and it will impact those with wages over 145,000. And that amount will be indexed for inflation. And what it says is for those individuals over that dollar threshold, you can no longer make deferrals, your catch-up deferrals into your regular tax deferred account. You now need to put that into a Roth account, so you won't get a tax deduction. And like I said, that'll be implemented in 2026. So this is another one where we just got an update here in January on the 10th, issuing some proposed regulations, just clarifying a few positions. Now, what I will say on this is they are proposed, which is why I have it underlined up there. Sometimes the final regulations don't include everything that you see in the proposed regulations. This is really just clarification as people had questions and how do we implement this, because it is to be implemented here in the next year. So that Roth mandate applies to your 401k, 403b, and those governmental 457b plans, but not to your simple IRA plans. And then the new regulation also says that if you offer your high earners this ability to do the Roth catch-up, you do have to make that available to everyone. You can't just offer it to the high earners. They have to be able to, anyone making catch-up should be able to make that decision. And that requirement, it applies only to employees with wages, which if you receive a W-2, it's going to be in box 3. And that dollar threshold was 145. And as I said, that will be indexed for inflation. Any individual that didn't have wages from the sponsoring employer in the prior year is not subject to that. And then the FICA wage threshold isn't pro rata. So if you're a high earner and you started in December, it really matters only what's on your W-2. It doesn't matter how much your salary is. That is not relevant for this calculation. And that's what falls into this look back wage rule. So new employees pretty much, no matter what their salary is, will have a free pass in this first year of employment because they had no wages in the previous year with this company. And so that Roth provision does not apply. And in some cases, they may get 2 years depending on when they started if they didn't hit that threshold and were part-time in the year before. So something to keep in mind for your newer employees. Another pretty important piece is that Roth is optional for benefit plans. Not every benefit plan has Roth. But what will happen with these regulations is that if you don't have a Roth feature, those individuals who are required to contribute via Roth, they won't actually be able to put in any catch-up contributions. And I pretty much see that most of our plans will go ahead and add this Roth feature if they don't already have it, because they certainly want to make sure that their employees are able to make catch-up contributions if eligible. As always, mistakes happen. And if they do, there are some within these proposed regulations, fixes for that, a W-2 correction method, and also that in-plan Roth rollover correction method. A few just minor updating mandatory items that are upcoming here in the next year. So some paper statements for defined benefit or defined contribution plans, you need to deliver at least one a year. Defined benefit plans, it's one every 3 years. But as technology goes, you can, an employee can elect out of that if they ask for electronic statements. And like I said, that will be for plan years after 12/31/2026. And so what's this timeline for all of these changes? So Secure Act 2.0 had a number of changes with implementation timelines in various years at various times. But the plan amendment timeline is a little bit later. So most retirement plans, their amendment timeline was extended. And so you will be looking at December 31st, 2026 to go ahead and amend those plans. But you do have to have them implemented at their due date. So this just extends the paperwork timeline. And certain other plans have until 2028 or 2029 to go ahead and amend those plans. And with that, I'm going to go ahead and turn this over to Kailee Hirschbock.
Okay, thanks, Kim. So my section is going to go over retirement plan audit preparation. This is going to be geared towards those plan management, plan administrators just looking at what you can do to get ready for the audit and things that you can implement throughout the year to make sure your audit is successful. Right, so my name is Kailee Hirschbock. I'm a manager in Boyer and Ritter's Employee Benefit Services Group with over 7 years of experience working on audits of 401k pensions and health and welfare plans. This section, we're going to break it up into 3 kind of key areas of focus. That'll be looking at your plan documents, what items you're responsible to maintain, how long you need to keep those, and then also just making sure that you're in compliance with those plan documents. Then we're going to take a quick look at some other responsibilities of plan management and finish it up with some things that you need to do after the audit concludes. Okay, so checking out your plan documents. As plan management, you need to make sure you have copies of all current and superseded plan documents and amendments. The audit team is going to need these items in order for audit planning to begin. That's because these plan documents give auditors detail on the provisions that were chosen by your plan and that need to be followed throughout the year. So that's going to be key for us to understand those as we go through planning the audit and doing testing. So these documents are sometimes provided by your TPA or retirement service provider, so they might not always be requested at the start of the audit, but they should still be maintained by plan management because many of these documents would be mandatory and requested if your plan is selected for review by the DOL. So you'll see to the right there, we have just a list of most of your plan documents along with the amendments. Just to dig into them a little bit, you'll see the basic plan document up first. That's the official legal document of the plan. It contains all of the non-elective plan requirements, but it doesn't have any of your specific plan provisions and the options that you chose. So to look at those, you're going to want to look at your adoption agreement and summary plan description. Both of these complement the basic plan document, and they're going to outline your specific plan details and elections that you put in place for your plan. That'll be your eligibility requirements, enrollment period, and any of those items, those will come up in the adoption agreement and summary plan description. So just some key things about those documents. You want to make sure that they're complete and accurate, that you have the fully executed documents and not, drafts or working copies. They should be easily accessible. We recommend using a secure centralized location, such as like a network drive. You just need to make sure that access there is limited to only authorized personnel. Well organized, you see there to the right, we have kind of broken out by folders along with the dates that each document covers. So just keeping them as organized as possible so you can easily pull them and access those. Keep your documents up to date. There are some items such as the IRS opinion letter that requires regular restatements. So that opinion letter needs to be restated. It's on a 6-year cycle. So you'll see we have the 2014 letter in there, the 2020 letter. The next letter that you would be responsible for is the 2026 letter. So just making sure you have all of the up-to-date documents. And finally, make sure that your plan documents are in agreement with how the plan is actually operating. So again, reviewing that adoption agreement and the summary plan description to make sure that you're complying with those plan provisions.
Okay, Kailee, this is Kim, interjecting a little fun story. After 25 years, I have a lot of fun stories. Maybe not, but 2 issues with plan documents, especially when we look at any kind of IRS audit. So I did have an IRS agent want to go back 10 years and wanted all original signed documents. And we had gone through probably, 3 third-party administrator changes, 3 HR changes, couple controller changes, and no one had the oldest documents. And finally, we were able to locate those in they were covered in dust in the bottom of somebody's cabinet, but we were able to find them, and the IRS, they were like, well, we need them. They didn't care that we couldn't find them because in theory, we are supposed to, you as employers need to keep those documents forever. And so you should always have them on hand. Another fun story, not so much, but we had an IRS agent go back to the inception of a plan during an audit, which, this plan had been in existence for, 30 years, 40 years. It was crazy. And they got charged an astronomical amount of money. I think it was $100 a page to get this original document from their old service provider. So just no one wants that expense for sure. But it really, you really need to keep these plan documents somewhere. My advice is if you have some old paper copies, scan those in and keep them in a drive so that you have them available. Thanks, Kailee.
Yep, for sure. It is absolutely imperative, that you maintain these on an ongoing basis. And if you're pulling them together now and you find out that you are missing older documents, just trying to track them down now instead of, waiting for an IRS review or DOL review to come up and be looking for them now, just to give yourself time to try to track those down and avoid some fees. Okay, so next, another key document that we're going to ask for during audit planning will be the plan census. So plan management is also responsible for providing this census to the auditors. At a minimum, your census needs to list out all of your employees, their date of birth, date of hire, date of term, as well as plan year compensation and any employee deferrals or matching for the plan. Having a complete and accurate census is absolutely imperative to the audit. And also many TPAs are going to require that you submit that census data for them to complete their annual plan level testing. So it is certainly worth it to take the time to double check that data and make sure everything there is accurate. Just some quick things that you can do to check your plan census. If you pull a payroll register, for the year, for the period that your retirement plan covers, you can make sure that your totals on the payroll census for wages, deferrals, and matching, that those agree to your plan census. Just one note, if you did have any deferrals that were made throughout the year that are falling outside of regular payroll, say you caught that someone's employer matching got messed up, they didn't get the full amount they were entitled to, and you wrote a separate check to fund that amount, that could cause some minor discrepancies between your census and your payroll records. But just keeping track of those throughout the year, and if you can provide that reconciliation detail to the auditor, that's hugely helpful. But anything that you can do just to make sure that census is accurate. In addition to ensuring that your auditor has access to all those planning documents and the census, it is super helpful if you can provide auditors with access to the retirement plan website. This allows us to just go in and grab that year-end audit package, compliance testing that's prepared, and any plan documents directly from the TPA. Then also, as we move through the audit and look at participant level testing and reviewing plan activity, having access to the website allows us to go in and look at specific transactions or dig into individual participant accounts immediately. So this helps to save a lot of time, and it also reduces the amount and frequency of requests that we have to send to plan management. So it helps to lessen your legwork as well. And then finally, just make sure you're informing your auditor of any plan changes, significant items, or potential problems within the plan so that we can review these and plan for these throughout the audit. All right, so after we kind of complete audit planning, as most of you know, we will make selections for what we need to complete individual participant testing. So we'll review and test areas like plan eligibility, contributions, loans, distributions, just to make sure that the plan is in compliance with plan documents and also with employee requests. So to do this, we do ask for a few different employee records. Most of these will be maintained in your employee files, and they'll include employees' support for date of birth, date of hire, and date of term support. For these, we're looking for source documents. A few examples of those are listed there below. We need these dates mainly to confirm different dates for employees and plan eligibility. So like their date of birth, if you have an age requirement, that could determine when they're eligible to enroll or if they can get catch-up contributions. Date of hire and date of term, we'll use that to see their length of service, and that could impact their vesting if they're looking to get a distribution from the plan. We'll also look at payroll records and approved pay rates. And then just a reminder that all of these details, the dates listed, the payroll information, should all be able to tie back into that plan census. If you do find that you are looking through participant records and you're missing any of this support, you want to work on trying to replace these throughout the year. You can just have an employee complete a new form, a new I-9,
write up a memo that states the date they were hired and have them sign that as hire support, and just kind of replace these throughout the year. And then further support that we need as we complete participant level testing. It's going to be the employee completed retirement plan forms. We've listed just a few of these on these slides. I'm not going to go through all of them because I'm sure everyone's already pretty familiar with them, but we will need this to make sure that the employees' elections, are in line with plan actions. So you'll want to make sure you either have these on hand or make sure that your plan provider is, keeping these and that they'll be accessible during the audit. And then finally, when dealing with retirement plan records and documentation, the motto is pretty much more is more. So you want to, in addition to all of those other pieces that we mentioned earlier, keep support for any plan activities throughout the year. That could be emails from employees, or even if an employee would call, the plan administrator and say, maybe they want to change rates from 5 to 8%, and they can do that on the website, but they just can't figure it out. They want you to do it. So obviously you can certainly go in and update that for them, but you want to make sure that you are keeping some type of support, to show why you made that change. Because, when we look at it in the audit, we're just going to see that their rate went from 5 to 8, and maybe we have the initial documentation at 5%, but nothing to support that 8. So just type up a memo. You could send an employee an email and say, just to confirm what we discussed on the phone, I'm going to increase your rate to 8%. Can you confirm that that's accurate? And then print that and keep that in their file. You can also keep any correspondence or communication with third-party administrators, discussions going over plan oversight requirements and things like that. If you discovered any plan errors throughout the year or anything that came up during the audit, keep documentation of these findings. You can add in the cause of the error and then also any corresponding action that you took to correct that. We also have the recommendation to keep meeting minutes if you have plan meetings, or any general management communication over plan decisions. That could be the decision to do profit sharing that year, the amount of the profit sharing, and who was involved in that choice.
All right, Kaylee, I'm just going to interject a funny story, funny-ish. Might not be funny to the employer, but it really is important to keep correspondence from employees. As auditors, we like everything signed, nice and tidy, all of that stuff. I had a new one come to me, and I've never seen this in 25 years. An employee emailed the employer and said, hey, I don't want to defer anymore. So they stopped deferrals. And at the end of the year, the employee comes back and says, well, I didn't tell you to do that. And the employer says, well, I have your email. And he's still fighting because he says, well, still, I didn't sign anything, even though he emailed it. So it's really important that when you do make those changes, that you go back and get that paperwork to back it up. And plan minutes, they're important too. As auditors, we want to see plan minutes. But when we get the response, well, we don't keep minutes. You do meet. And so it's important to at least document you are meeting with your fiduciary. You're going to meet with the investment advisor, and to show that you're really watching over the plan and the plan assets. At the very minimum, we want to see, okay, you met with them in January. Here's what you discussed. And typically your third-party administrators or asset custodians will have some kind of report that we can sit there and go, okay, you are taking your responsibility seriously, even though maybe you're not formally documenting those minutes.
Mm-hmm. Yep, and all of this documentation is just key not only for the audit to help that run more smoothly, but also just as plan administration, to have support for the actions that you're taking throughout the year. All right, so then we went through a lot of documentation and records. So the question is, how long do you need to keep all of these items? So there's two specific ERISA laws that come into consideration with regard to record retention, and that is Section 107 of ERISA and Section 209 of ERISA. So Section 107 states that any reporting and disclosure records must be maintained for up to 6 years. And then Section 209 of ERISA states that eligibility and benefit determination records must be maintained indefinitely, or at least until the benefit or eligibility calculation is no longer needed. So we're going to provide a handout after this that'll be sent out along with the slides, and that'll kind of break out the bulk of your plan support and classify that into one of these two sections. But if you do have any items that you're not sure where they fall, you can always reach out to your auditors, to us, and get clarification on how long you need those items for. And that'll bring us into polling question number 3.
Okay, so polling question number 3 is asked, which of the following is not considered a source document to verify employee's date of birth? A, the employee's I-9, B, a screenshot of employee profile with date of birth from the HRIS system, C, a photocopy of the employee's driver's license, or D, all of the above are source documents. We'll give a minute for everyone to get their answer in, and then Kailee will go over the results and the correct response.
Okay, thanks, Jamie. All right, so the correct answer here is going to be B, the screenshot of the employee profile. So while your HRIS system is probably pretty accurate and usually a great, quick, easy way, for you guys to pull employee data, during the audit, we just require access to the original source documents, and that's to allow us to verify that there wasn't any, human entry errors or typos in getting that information updated. Okay, and then just to go over the plan document section and a couple action items for plan management if you don't have these things already in place. So you want to make sure that you have plan documents maintained and that they are housed in a secure and centralized location, that the documents are organized for easy access, and you're retaining them according to those ERISA laws that we discussed earlier. And finally, potentially most importantly, that you know and understand the provisions detailed in those plan documents and make sure that your plan operations are following those provisions that you had set. Okay, so you have all the plan documents and participant support, you're following provisions in the plan. What are some other responsibilities of plan management? So this list is not all inclusive, but just kind of some highlights. You want to make sure that you are making plan decisions in the best interest of employees, that you're educating employees on the plan provisions and providing notices to them timely. You want to ensure accuracy in reporting and plan financials. So this will be reviewing and reconciling items like your Form 5500, the audited statement, those quarterly and annual reports that come from your TPA, as well as any information that you're uploading to your plan providers. Make sure that that's all correct before you have that submitted. Make sure any deferral rate feedback or other items that they're kicking out to you, that all of that looks accurate. And then you also need to review plan providers and ensure they're meeting expectations. Yes, you hire them and pay them to do their job, but it still falls on plan management to make sure they're doing that according to, standards and that everything there is appropriate. You need to review your plan investments. Most of the time this is done at an annual meeting, with your investment advisor or TPA, but you want to make sure that you have reasonable and sound investment options for your employees, and also look at plan fees and make sure that they are reasonable, nothing crazy high that would negatively impact employees. You need to maintain fidelity bond coverage for the plan. That coverage must be 10% of plan assets, and that is subject to a minimum of $1,000 and a maximum of $500,000. An exception for any plans holding employer securities, that maximum actually goes up to $1 million. And finally, ensure that you have proper processes and controls in place to ensure that your plan is running appropriately. Okay. So then just to conclude, once the audit is complete, there are still a few responsibilities that plan management needs to make sure they're handling. Most importantly is you still have to file the Form 5500. So for most plans, your plan provider is going to handle the bulk of this step for you, but they'll still require a plan administrator signature or approval. So you want to make sure that you're in contact with them and that you coordinate to get this completed before the deadline. Again, making sure that the audited financial statements are attached to the end of your 5500. Then also, if any reportable findings or errors were noted during the audit, review any auditor correspondence over these items. And if corrective action is required, make those as soon as possible. And lastly, determine why the error occurred and kind of what you can do to prevent that, or at least, if it would happen again, that you can catch it and correct it quickly. So just review and strengthen your internal process and any controls. Okay, and that is going to wrap up this section of the program. So I'm going to switch it back over to Kim to introduce the next speaker.
All right, thank you, Kailee. Thank you, Kailee. We're going to go ahead and move on to our next speaker, Jaime.
Thank you, Kim. In the next section, we're going to review some common employee benefit plan audit findings and some ways to prevent them. My name is Jaime Onk, and I'm a manager in Boyer & Ritter's Employee Benefit Services Group. I have over 20 years experience auditing 401k, pension, and health and welfare plans. In this section, I'll give a brief overview of the audit process for employee benefit plans. And for today's discussion, I'm going to focus on 401k plans. To help better understand the issues that often arise during the EBP audits, we'll discuss 8 common EBP audit findings and some ways to prevent them. And then we'll give a few updates for 2025 related to error correction. An annual independent audit is required to be performed for plans with over 100 participants, those with an account balance in the plan as of the beginning of the plan year. When performing an independent audit of an employee benefit plan, we start by getting an understanding of the internal controls and operating policies and procedures in place. We test the amounts reported in the financial statements, and we test for compliance with plan document provisions in the areas like eligibility, contributions, distributions, and then test related information like employee data and payroll information. As a result of the testing performed, we may note findings in 3 main areas: financial statement misstatements, internal control deficiencies, or errors in the design or operation of the plan. And today we're going to cover 8 areas where we most commonly have audit findings. We'll discuss each of these areas and the issues that we commonly see and what measures can be taken to prevent these issues going forward. And the first finding relates to missing or outdated employee file documentation, which Kailee did cover, talking about maintaining employee records. But just to point out here that the issues that we see can relate to eligible employees getting missed for enrollment or a miscalculation of eligibility requirements due to incorrect employee data. And then we also see where there's no documentation that all eligible employees have been made aware of their ability to participate in the plan. So the prevention strategies here are just to be reviewing that information, making sure that it's complete and accurate, addressing any missing information timely, and again, looking at your policies and procedures for maintaining records for those eligible but not participating employees, like obtaining a signed opt-out form. The second common finding relates to plan documents that are incomplete and/or amendments are not being made timely. Again, we see inconsistencies with how the plan is operating versus what the plan document mandates, like eligibility exceptions not being applied, no annual true-up happening when it's required by the plan document. So Kailee did cover ways to maintain those plan documents. We would also just say to have regular discussions with your TPA to make sure the plans are being amended timely for any recent legislation or regulatory requirements or any changes in operations of the plan. And emphasizing that it's important the appropriate individuals that are involved in the day-to-day operation of the plan have access to those most current plan documents. Make sure that the plan is operating in compliance with the plan provisions. The third common finding relates to a lack of plan oversight and/or that documentation of the fiduciary duties that are performed. Kailee went into detail about the plan management responsibilities. So what we tend to see is either these responsibilities aren't being performed or there's that lack of documentation and no formal documentation of decisions made related to the plan, like the decision whether or not a discretionary employer contribution is made for a given plan year. So we want to make sure that those meetings are being held on an ongoing basis and that there's a record of the meetings held and any decisions made regarding the plan. That could be informal minutes, a corporate resolution, an internal memo, just somehow maintaining documentation for those decisions made. The fourth area that we commonly have findings is one of the most common findings that we see related to the late remittance of participant contributions. For small plans that have less than 100 participants, there is an eligible safe harbor option that those remittances of employee withholdings can be made within 7 business days from the dates the amounts are withheld from their pay. But that 7-day safe harbor option does not apply to large plans. So those with more than 100 participants that will require an audit. And that's due to the varying level of complexity in the payroll system and the sophistication of the accounting functions for these larger plans, where they may be able to remit on a more timely basis and don't want to be allowed to have that 7-day window to hold on to that money. The employee withholdings, which are contributions and loan repayments, need to be remitted as soon as administratively feasible, which is the earliest date on which the contributions can be reasonably segregated from the employer's general asset. What we commonly see is inconsistent remittances. The auditors and the Department of Labor will look at trends for remittances, and any outliers may be deemed late. So if a plan sponsor is consistently remitting within 2 to 3 days of the pay date, if they have any outlying remittances that have taken longer, those could be deemed late, since the plan sponsor has demonstrated that they can consistently remit within a shorter time period. If late contributions are identified, they're considered a prohibited transaction. They're reported on the Form 5500 and in a supplemental schedule to the financial statements. And corrections would need to be made that include remitting the contributions to the plan if that has not already been done, along with any lost earnings, and then filing a Form 5330 to pay the related excise tax. To prevent late remittances of participant contributions, it's important to establish a clear remittance policy, working with your payroll provider to determine the earliest date for segregating deferral deposits and ensuring timely deposits by putting proper procedures in place. It's key to have a secondary individual trained to perform the remittance if the individual responsible is not going to be in the office. Employee vacations and sick time, etc., are not considered valid reasons for not remitting contributions timely. If for whatever reason deposits are remitted outside your normal remittance window, it's important to maintain documentation of the cause of the delay and any relevant communications or paperwork. For example, if there's some kind of bank error or issue with the bank, to maintain a record of why you have something outside of your normal remittance window. This brings us to polling question number 4.
All right, so polling question number 4. So this is a fun one because I think Jamie may be the fun one. We're the serious ones. So what do you most look forward to watching on Super Bowl Sunday? A, the game, B, the commercials, or C, the halftime show? So before I turn it back over to Jamie, I'm going to tell you mine. Mine is B. I love the commercials.
That used to be my favorite, Kim, but I feel like you can see a lot of them before you even get to Super Bowl Sunday now. Okay, and it looks like, Kim, most people agree with you that commercials took the lead for that polling question. Okay. The 5th area where we have audit findings relates to compensation definition errors, where the wrong definition of eligible compensation is used to calculate contributions. And this can lead to incorrect employee and employer contributions going into the plan and can also impact compliance testing. So for example, if the base definition for compensation is defined in the plan document as W-2 wages, and then specifically excludes things like reimbursements, other expense allowances, fringe benefits, we may see situations where the deferrals are being calculated on things such as auto allowance. So we want to make sure that what is being excluded per the plan document is not being included in the 401k wages. So we can prevent this by ensuring a clear understanding of the definition of compensation per the plan document, specifically what is included and excluded, and holding regular trainings for the HR and payroll teams. It's also important to provide the 401k provider with the compensation information they need to complete year-end compliance testing, and provide payroll provider with correct information to calculate the 401k wages per payroll. So ensuring and performing a regular review that the correct pay codes are being included in the accumulation of 401k wages in the payroll system that are used to calculate those deferrals. The next common finding relates to inaccurate calculation of vested service. Participants are always 100% vested in their deferrals, but become vested in any employer contributions based on a vesting schedule specified in the plan document. And this gets back to maintaining those accurate employee records, as the vesting schedules typically are based on years of service. And this is important to make sure that the correct amount of benefit payments are being paid out of the plan.
And Jamie, I'll interject a fun little vesting story, or maybe horror story. I think it depends on your viewpoint on vesting. It does happen commonly that plans will maybe change asset providers. Maybe they want mutual funds instead of an insurance company. And I worked with a plan one year where they changed asset custodians, moved everyone over, and somehow the vesting for every single employee was reset back to zero. And it wasn't checked. So that it's really important to check that, because of course we come out to do the audit, and that's one of the first things we see is this doesn't make sense. And then we discover that every single employee has the wrong date because they didn't put the initial service in there. And so they did have to go back through every single employee and fix that. So it's important to make sure that when you're looking at vesting, you've got the correct information.
Thank you, Kim. Yep, and that falls into the prevention strategies with reviewing the plan documents for the vesting requirements. Like Kim said, verify the vesting service credits for participants, and then make sure that the vested amounts are calculated correctly before approving withdrawals to be paid out of the plan. Our seventh common finding relates to discrimination testing failures not addressed. The annual discrimination testing is performed to ensure fair distribution of benefits amongst employees. A plan has 2.5 months after the end of the plan year to correct any excess contributions. Otherwise, a 10% excise tax must be paid on the excess contribution amount. So what we typically see is when the testing is either not performed on a timely basis, or any failures resulting in excess contributions to be refunded are not addressed timely. This can also cause issues if the employees that are impacted have since left the plan. So this can be prevented by consulting with your TPAs early on to make sure that you're going to be providing them information timely to get the annual testing done, monitoring participation rates of your highly compensated versus non-highly compensated employees, and then making sure that if there is any return on excess contributions, that those are made timely. And the last common finding relates to inaccurate or incomplete employee census data. So Kailee briefly talked about the census data, the census file that's used by the auditor for making testing selections and used by the TPA for compliance testing. So we typically see here that inaccurate information has been included, or the file itself is incomplete and doesn't include all of the employees. So Kailee talked about how that file can be reconciled back to payroll records to make sure that it's complete and accurate before it's provided to the auditor and the TPA. We just wanted to give a couple updates on things that are related to error corrections, some updates for 2025. We have the voluntary fiduciary correction program that gives plans and fiduciaries a way to correct ERISA violations without the transaction costs and burden associated with enforcement actions for violations of the fiduciary standards in Title I of ERISA. The DOL published an amended and restated VFCP on January 15th, 2025, to simplify and expand the program to make it easier to use and more useful for employers. And the two most significant changes relates to there's two new self-correction features for certain failures to transmit timely participant contributions and for certain participant loan failures corrected under the IRS's Employee Plans Compliance Resolution System. The criteria for correction hasn't changed, but they have now made a more streamlined online process to submit the corrections if such corrections are required. And then we just wanted to touch on penalties and fines. So aside from the administrative burden of correcting any errors or compliance violations, there can also be a financial impact to the plan sponsor for certain benefit-related violations. And the DOL has recently issued some adjusted penalty amounts for 2025 that increase those penalties. So again, just want you to keep in mind that it's not just the cost and time from for correcting errors, but there could also be a financial impact as well. So in summary, it's just important to know where issues are most commonly found during the audits and understand some policies and procedures that you can put in place to prevent these issues from occurring. These preventative measures can avoid costly fines and payments. If and when such errors do occur, plan management should work with their service providers to make any necessary corrections in a timely manner. And with that, I think we have a few minutes for questions.
All right, so I have one or two questions in the queue. On your screen right now, you can connect with us, scan it in on LinkedIn. So go ahead and do that. But I'll go ahead and ask at least one question. I think we have time for that. So this question relates to Roth-only catch-ups for high earners. So the question is, if an employee has more than one job, is the $145,000 per year compensation threshold based on their aggregate compensation? And the answer to that is no. You don't add up W-2s. It's one W-2 and it's based on that employer. So if you have two different employers and your total is 145, that doesn't matter. You're not subject to it because it's each individual W-2 on its own. And another Roth-only catch-up question that came in, it says, are self-employed individuals required to make catch-up contributions on a Roth basis? The answer to that is no. If you're self-employed, you're not getting paid wages, you're not getting a W-2, and so you don't have to do that. And then what if a plan doesn't already offer Roth contributions since they're optional, right? So the answer is the IRS isn't going to force you to offer Roth. However, as I mentioned before, your high earners would not be able to make any catch-up contributions. So as I said before, my guess is most employers will go ahead and add that Roth provision. And with that, I think we're pretty much at time. Everybody, go ahead, enjoy your lunch and the rest of your day.